Hi guys, it's January 11th. We record this interview right in front of the CPI release, which will follow tomorrow. Important metric for all the market participants, of course. Julian, we're in this low to negative growth environment. If we look at the PMIs, also leading indicators of PMIs, we combine this with these harsh Chinese reopening and hope that it signals market participants. And if it wasn't enough, we still have hawkish central banks, especially the Fed, which seem not willing to cut rates right now. So, Julian, how do we get out of this mess? Will we see a hard or soft landing?
So, thanks, Lucas, for having me on the show. Sorry, I apologize. I just realized that if you look at me on my background, I'm sort of invisible because I didn't realize I was wearing sort of white and cream, so you can't see my arms. But trust me, they're there. They're there, right? So what would I say? I think, look, this is the big dilemma. I think, and there's a huge divergence, I would say, between the fixed income markets and the equity markets. And the equity markets are assuming a incredibly benign soft landing. I mean, if you look at and just before the show, this is what we were talking about. It's not some of the relative price action that I find confusing a little bit at this point, Lucas. It's the absolute risk rally that we've got going on in a bunch of assets. So whereas so equities and risk assets are presuming a sort of soft landing. I mean, you could argue dominated by maybe the China reopening would be a narrative that would fit this. And yet on the other side, we've got fixed income, which is pricing in aggressive cuts, certainly in the US, right? And, where we're sort of going to march rates up to the top of the hill, and then we're going to immediately start cutting them. And that doesn't really gel with the equity price action, because you could say, okay, well, maybe the fixed income market's assuming just a massive recession. You go, well, the equity market sure as hell isn't assuming that, right? So something kind of has to give. And I think I'm trying to mentally get my head around it, but in two respects. Look, I think growth is slowing in the United States reasonably dramatically. We went in November, we went long US fixed income, caught a pretty decent percentage of that kind of move.
Short or long end of the curve?
Yes, we were mostly focused on the long end of the curve, Lucas, and the reason is relatively simple. So we kind of got in at, I want to say, mid-teens in 10-year Treasury yield. So I think it was like 412, 415, and we run this alpha capture portfolio for a hedge fund, and we've done very well over this last year. So the reason why I focused at the long end is because I believe that the Fed is pursuing this policy called opportunistic disinflation. So if you go back, this was first pursued by Greenspan in the mid-90s, and it's one of two options available to a central bank when inflation is this high. There's deliberate disinflation. Okay, that's the Volcker option, right? You take Fed funds in this case, and you raise them above headline inflation, and you literally, to use an analogy, you take the economy out into the swimming pool and you shove its head under the water till it drowns. Tough, okay? Opportunistic disinflation is a little different. You push rates into the slightly restrictive zone. So if you want to use that analogy again, you take the economy into the pool, kind of hold their head at a point that's very uncomfortable. So they're spluttering for air, okay, but you're not drowning them. You're just holding their head there. And then you hope over time that one of two things happens. Either the water itself drains out. So let's say we get some positive event. We get a positive supply shock. We get a positive productivity advancement, right? And that inflation impulse drops away completely. Okay, and then that represents essentially the water drains out, and so you're standing there and you're like, okay, and you can take your hand off the top of the economy's head, or the economy drowns under its own weight, right? And oh, that wasn't my fault because I didn't really jack rates up. But the problem with that, or not, the potential thing that the markets don't realize is when you follow that opportunistic scenario, it takes not months, but years historically to wring out inflation out of the system, right? Years. I mean, Greenspan pursued this policy in the mid-90s during a period where we had probably the most extended post-war, one of the most extended post-war periods of productivity advancement, where productivity basically went from 1 to 6 in the US, heading into, with all that capex spending heading into the dot-com bubble, okay? And it took 4.5 years to reduce CPI by about 200 odd basis points. And Fed funds didn't really change, Lucas, right? I mean, they change a little bit, right? Because, you know, as inflation comes off, you don't want real rates tightening, so the central bank can lower rates a little bit. But this idea that if, you know, we're going to just march rates up or march rates down, and then march rates down, doesn't really gel with what the Fed, and that's why the Fed keep coming out and keep saying, for an extended period, for an extended period, for an extended period. And they aren't talking bloody months. Now, as I said, maybe the bond market is sensing much more recession, but then the equity market is completely mispriced, I would say. And, you know, and the other dichotomy is clearly, you know, and I've been talking to this about my clients. You know, I look at my, say, for example, I like using Sweden as a canary in the coal mine for continental Europe. It's a small, open economy. Its data tends to turn a couple of months before European data. And its data is dire. I mean, it's utterly dire. And yet you look at the performance of the OMX. Now, you can make a case, I would guess, by saying, well, you know, my model suggests negative 6% GDP growth in Sweden, which would be the lowest in 30 years. Retail sales have already dropped to the lowest in 30 years in volume terms. And then you can say, well, oh, you know, inflation's 12%, so your nominal growth numbers are still +6, right? Because real growth is down, you know, take inflation out, and you can say, well, maybe equity's just pricing off nominal GDP, right? I mean, they earn nominal income, so maybe that's, you know, earnings are nominal, so maybe you could argue that that's the case. It didn't happen in the early 90s like that. I mean, the last time they had an inflation bout like this, I mean, you know, the OMX dropped 40%, and so I look at the first few months of the year and the first few weeks of this year, and I say, I don't have a problem with the relative performance. I think, and I think I said on your show last time, you know, precious metals against the S&P, I really, really like. I think the whole of the world's equity market is going to outperform the US for the next, we are breaking decade-long trend lines in absolutely every major equity market pretty much against the US, right? So IBEX against, you know, so the Spanish equity market against the NASDAQ, the world, MSCI world against the US, you know, Europe against the US, European banks against US banks, you know, and all of this suggests to me that there's this big rotation trade. But then the question is how does it happen? Is it this nice rotation, Lucas, where you get everything rallying, right? But Europe just rallies more. Emerging markets just rally more. You know, precious metals rally more. Or do you get this nasty one where the US equity market shanks, collapses, and Europe goes down less? And when I look at the macro, that's kind of where my head's at, but the price action at the moment doesn't fit that. And I think it is just positioning flow as we move into the first half, or, you know, the first few weeks of the year, and you're getting positive inflows. But those are my kind of, I really, really think that this US equity outperformance now is done. I think, you know, and I've been saying this for a while, that the next decade is going to look nothing like the last decade. And I've used this expression, you know, the first will become last and the last will become first. You know, that biblical expression, you know, a rotation of biblical proportions.
And I would certainly make sense also in my opinion. And you talked about, for example, how long it actually takes for inflation to come back down. And you mentioned it, if we look in history since the 1970s, how long it average took for inflation to come back down to the target rate. It took way longer than a market.
Yeah, I mean, I wrote this thing to clients within this discussion about opportunistic disinflation, and I said, if you go back and look at the papers written around opportunistic disinflation in the 90s, there was one by the San Francisco Fed, for example, and they questioned the credibility of the policy because they said part of the problem is it just takes, if you're not prepared to drown the economy, if you're only prepared to kind of hold it in a period of sort of extended grinding out pain, it can take you a long time to grind out inflation because you don't really hammer it down. And they said, for that respect, it's quite dangerous policy to pursue because you could unanchor long-term inflation expectations if it doesn't come down very quickly. You could start building in higher term risk, premium risk into the long end of the bond markets, where investors go, I don't think your policy is as credible as you think it is, right? I'm not prepared to, hold these bonds for like zero risk, right? I want a premium for holding that duration risk, which is what term risk premium measures. And in that respect, I think it's quite interesting. We did that San Francisco paper did some work on how much, even if you get a recession, how much inflation comes down. And the median decline in a recession for US headline inflation, okay, from the start of a recession to 1 year after the recession, in the whole of the post-war period, and we updated that work, is 1.9%. So let's say we go in at 6.5, right? Or 5.5, right? Then you're still talking, 4.5, 3.5 for headline inflation. And that's going through a recession. And then, oh, by the way, the Fed's policy, if you pursue opportunistic disinflation, because it takes time, you actually have to be more aggressive from a central bank perspective coming out of the recession than you would all normally be, because you haven't fully wrung out those underlying inflationary pressures, Lucas. You have to be quicker off the mark in terms of hiking than you would typically normally be.
Julian, in terms of dropping inflation, give me your opinion on the following assumption. I think during the first half of 2023, it seems likely that inflation will come down quite hard.
Yes.
Simply because of the basis effects of the high oil.
Yeah, and you can see it. You can see it now in I think more importantly, you can see it now in company pricing. So companies are starting to reduce prices because they're finally starting to get some demand weakness, right? So up until now, Lucas, right, the sheer size of the stimulus meant that they were cushioned, right? They could just pass through any price increase they got straight to their customers. Add in the fact that in the US, I know the rest of the world likes to think of the US as a highly competitive market. It's a highly oligopolistic, monopolistic market, right? I mean, this is, if you remember back in the summer of COVID, Biden was complaining about slaughterhouses, right? And the lack of meat supply, right? And why? Because there were basically 3 main slaughterhouses in the whole of bloody US, right? It's really not that competitive a marketplace. So you added that into the stimulus money that we got here in the US, and it was very easy for the companies to pass on any price increases they want to maintain margins. In Europe, that didn't happen. Like, God forbid it had, because given that PPI in Germany hit the highest level since the Weimar Republic, then you would have been seeing 30 or 40% HICP numbers. Well, you didn't, because European companies couldn't pass those price increases through. Right.
And then also, on the other hand, if we say first half of 2023 seems likely inflation drops harder, second half of the year could become more important.
Yes. And I think, look, it really depends on, I'm thinking, right here, there's a number of things going in the Fed's way. I mean, less so yet in the ECBs. I'm still quite worried about Europe. We could talk about that in a second. But when I look at the US, things are going in the Fed's ways. Inflation is coming down. demand for labor is falling, and quite rapidly now. Credit terms are tightening. If you look at the banks, what they're doing, and that's going to hit everything from retail sales to small businesses to capex spending, etc., etc. Now, we're not yet seeing job cuts, and I think it's important to remember that the Fed has job cuts priced into their SEPs, their forecasts. And so that's kind of going in their way. But the big fly in the ointment remains this labor market, right? I think it's absolutely necessary to move from just, falling job demand isn't enough. We really need to see job losses. And I think they're coming. But when they come, that means a recession.
The labor market tends to be more of a lagging component
Correct.
of the economy. I just put it on the screen. We saw some weakness in temporary help services, for example. Those are likely to cut first.
Yep.
On the other hand,
if you look at things like NFIB, so small business hiring intentions, those are falling. But it's around that demand component you're starting to see the first weakness. It's not yet around the actual hiring component. There still seems to be a rump of companies who have struggled to hire people, Lucas, are still trying to find people as they come available from, maybe tech, right? I mean, the classic was, you saw in the UK that Land Rover, Range Rover came out and said, if anyone's lost their job in the tech sector, we'll hire them, right? Because the car companies haven't been able to hire these people, right? So I still, for the moment, there's a bid out there, and that's not good enough. I mean, if you look at I tend to pause and delve into the ISM manufacturing conference calls at some length, and back in the summer, what they call the hire to forced manage ratio, so number of companies that are hiring versus those that are managing down employment, was 6 to 1. It's subsequently in the last 3 months fallen to 2 to 1, but it's still 2 to 1 higher over reduce, right? And that's not good enough. Right? We need to see more. So I'm definitively in the camp that either the Fed, I think the Fed, I don't know if the Fed will get much more than about 5%. But this idea that as soon as you see weakness, they have to turn around and start easing, I think is a joke at this point. Right? I mean, this reaction function is built upon this assumption that we still live in some sort of post-2008 kind of world, and it's utterly frigging changed, right? They are not your friend, right? Everyone seems to think that, I've tweeted this, right? And I know you follow me on Twitter. Everyone assumes that the central banks are your friend. Well, they're your arch enemy now. They are your nemesis, right? If you're a long equity investor. So I think there is a risk that inflation comes, there's not a risk. I think the base case is inflation comes down first half of the year. We start to see the weakness in the data, and it's pretty clear that the algos are still programmed that bad is good, right? Weak data is good, and that somehow the Fed struggles to get to grips with the equity market. And I have this thesis about what I refer to as hyper-financialization, where and I think we've talked about this before, but it's whereby, if you thought of the old chicken and the egg story, which is the chicken, which is the egg, right? Is the real economy the chicken? Is the financial market the chicken? You would assume the real economy was the chicken, right? The real economy sets inflation, it sets growth, it sets profit margins by that way, et cetera, right? Not in the US. Financial market literally leads the real economy because of the reaction function of CEOs, because they're only paid to be shepherds of their equity price, right? So you can see it now. Companies, tech companies are cutting employment because their stocks are down. So the problem will be is if the Fed cannot get to grips with this equity market and drive it significantly lower, then we will have we'll have kind of a soft landing in the first half. The data will refirm in the second half of the year. And far from being off to the races, the Fed will actually have to come down harder again in the second half of the year, because we will not have wrung out the weakness. We will run out those inflationary pressures. They'll re-emerge and will be off again. And I think if you go back and you look at the 70s and 80s, that would be a bloody disaster for risk assets at that point, because then everyone will get bulled up only to get kicked in the teeth again by the central banks and then realize their resolve.
Julian, what also will kick off at the end of this week is the earnings season with US banks starting. If we look at the earnings expectations or the consensus, it's still relatively high, right?
Yeah.
Do you
but I mean, you're still running. Look, I think provisioning is increasing. We're starting to see some nascent signs of credit card defaults picking up, some auto defaults picking up. Clearly a slowdown in housing. But the economy, remember, it's always backward looking. The economy in the last quarter was pretty okay, right? I think it only starts to get problematic in Q2, and we won't be looking at, I mean, unless these companies forward warn, right? And that's a company to company specific, right? We saw last quarter how Microsoft told you things were slowing and Apple lied, right? They just refused basically to give you any forward guidance and just sort of went, it's great, everything's fine, honestly, it's good, right? And they're not really radically different as companies. And so Apple stock rose and Microsoft got kicked in the teeth, right? So it really comes down to the forward guidance, and it isn't always that reliable. So I just don't think yet is the time for the weakness. It's coming, but now is not the time.
Another component, macro component, where we actually see weakness right now is the US dollar. I know last time we spoke, you liked emerging markets, but you didn't bought into it yet or had high exposure. Emerging market and US dollar have quite a negative correlation.
So yeah, they have a very negative correlation. Look, I think someone obviously came about this with the ECB suddenly turning radically more hawkish. I think everyone was assuming they'd take rates to sort of 2 and change, and my understanding is they think they want to take rates to 4 and change. Whether they actually get there, we'll actually see. Talking about QT, Lagarde's finally seemed to have found a backbone. I wouldn't call it a Germanic, Teutonic ramrod backbone, but at least she's got one, right? She's which we didn't think she had before. And that obviously clearly has helped the euro. And it's really the euro's been leading the way. I mean, look at price action today. It's the euro's up against absolutely everything. And I think that's flow. I think it's going to be very interesting in the next few, let's say, month and a half. And the reason I say that is historically, if you go back to 1972, so the start of freely floating FX, 80% of the time, the highs and lows of the year occur in January or early February of European FX against the dollar, right? So what would be nice now to get a slight dip in the euro and it to sell off, I don't know, down to whatever level, and then to rally again through the rest of the year. And I think, Lucas, that a lot of that rallying goes back to my original comment about the relative performance of US equities, right? The US has done what it did heading into the dot-com bubble, where we had this experience, a period of we refer to as US exceptionalism. So US exceptionalism is a period where you have these truly reflexive cycles. So I don't know if you understand or your listeners understand the concept of reflexivity as discussed by Soros, but basically the way he used it was the idea that when you purchase the asset, okay, it underpins the fundamentals that actually support the asset, right? So it becomes a truly virtuous, self-reinforcing cycle, right? You, as a German, turn around and say, oh, I like the dollars rising, right? Which has been, since 2011, basically. I want to be long dollars. So you buy dollars and then you say, oh, what do I buy? Oh, let me buy some corporate debt because that's quite high yielding, right? So You buy US corporate debt, and what do the corporations do with that? Well, they buy back stock. So as they buy back stock, you go, oh, the US equity market's outperforming. Let me buy some more dollars. Let me buy some more stock. And as that happens, the wealth effect increases. So what does the Fed do? They raise rates more than the ECB. And this whole thing becomes virtuous. And it sucks in money all from around the world, right? And you get this US equity outperformance, US dollar outperformance, and you get this great 2-for-1 trade as a European, right? You're long dollars, you know, it's outperforming the euro, and you're long US assets, and it just rips, right? Well, the other thing that it's doing is it's funding a US current account deficit because of that wealth effect, the US economy is booming. And once again, we've been running a record US current account deficit, but it becomes quite unstable, that relationship, Lucas, right? It's virtuous to the point that it isn't, right? And it can be, it's reflexive on the upside, and it can become reflexive on the downside. And it's unstable because it depends on, it's like a three-legged stool. There's 3 variables. Number one is the currency. So if the euro stops falling and starts rising, you go, oh, I've got this NASDAQ position, and on my statement, it's gone down in value, right? The NASDAQ may have not changed in value at all, but the euro's gone up, so you're down money, okay? Option number one. Secondly, the US equity market does go down, right? Let's find it really is a bubble, and it does go down. You are losing money, you take your money home, the euro goes up, the whole cycle starts to unwind. Option number 3, the Fed is so aggressive that the US current account deficit shrinks, and that funding element, which is what you're inadvertently providing, right, to fund that current account deficit, you're a foreigner buying US assets, providing that funding so they can run that current account deficit, unwinds. And then the US doesn't need your money anymore, and it goes home. So we are, I think, in one of those periods where the dollar will start to fall, predominantly, at least initially, led by the funding currency. So